Signs of economic recovery in China, according to new data released by the National Bureau of Statistics for August. Industrial production rose 4.5%. Retail sales were up 4.6%, both increases from the month before, and also, by the way, better than expected. The improvements have been attributed to the stimulus measures from policymakers. There is still room for improvement. Investment in China's property sector was down significantly, but the upbeat data saw JP Morgan raise its GDP growth forecast for China from 4.8% to 5%. Zheng Quying has more from Beijing on this new growth.
China's industrial production improved in August, expanding 4.5% from a year earlier, up from a 3.7% increase in July. That's according to the country's National Bureau of Statistics on Friday.
In terms of sectors, the value added in mining increased by 2.3% year-on-year, manufacturing went up by 5.4%, and the production and supply of electricity, thermal power, gas, and water grew by 0.2%.
Retail sales, a key metric for domestic consumption, grew 4.6% in August from a year earlier. And consumer inflation also showed signs of recovery in the same period for the first time in more than 2 years, after dropping into negative territory in the previous month.
In August, the consumer price index went up by 0.1% year-on-year, while the number for the previous month was down by 0.3%, and the improvement is due to the continued recovery in the consumer market, as well as improvement in demand and supply.
Officials say imports and exports saw a 2.5% decline year-on-year in August, but the number was narrowed by 5.8 percentage points compared to the previous month. And employment was generally stable, with the urban surveyed unemployment rate dropped. Officials say China's economy still faces some challenges, such as insufficient demand and complicated international political and economic situation. But they said that they are still confident that these challenges will be addressed through deepening reform, opening up, promoting innovation, and pursuing high-quality development. Zheng Chunying, CGTN, Beijing.
For more on the state of the Chinese economy, Albert Keidel is the part-time professor at GWU and author of China's Economic Challenge, the Unconventional Success. Nice title. First, let me get your reaction to these numbers that just came out over the past 24 hours or so, specifically on the Chinese growth figures.
Well, I think they are, as you reported, an improvement, a modest improvement, and I think so we can really say there isn't a major significant change, even though there are modest upticks and the inflation finally moved barely into positive territory. But what's interesting is to look up below the surface, that a great deal of these numbers impact are influenced by the real estate sector, where the investment dropped almost 9%. And so if you can extract or look at what's not influenced by the real estate sector, we really have seen a positive process going on in the Chinese economy through this summer, and this is confirmation that that process is gradually improving. We have really strong growth in fixed capital investment in a lot of other sectors that are really, I think, quite encouraging for the medium and long term.
There's also a number of foreign investment into China, and it used to be a number well over 100 billion, and today it's a fraction of that. And I have to think that's part of a lot of these companies diversifying their investments throughout the rest of Asia. I mean, that has to ultimately have an impact on China, does it not?
Well, it does, but China also it's understandable that with the United States friendshoring and so forth, the impact for China is that it won't be exporting directly to its major modern developed country markets, but it will be through other areas. For example, exports to Singapore are way up. And so it's processing exports using Chinese inputs, and that pattern is going to get stronger and stronger. So the foreign direct investment also is not dying in China. We're seeing decisions by a lot of major foreign corporations to expand and increase their capacity both to sell and to produce. So yes, I think it's a hit that's understandable in the current geopolitical sort of malaise that has been introduced really since the beginning of the Trump administration between China and the United States, and has affected Europe to some extent, but not as much. And if you look at the export markets, Latin America, ASEAN are bigger markets for China than the United States, and they both have strong expanded exports for this year so far. So I think the jury is out on how bad a hit there will be if foreign direct investors modify their their former enthusiasm. Right. But I wouldn't think it's that serious.
The Communist Party, specifically in Beijing, and the policymakers, has taken some criticism for not doing enough. But then they did some, and now we've seen these better numbers. Should they get credit, and what else maybe should they consider?
It's interesting. I think I and a number of others thought there would be a much bigger stimulus package, but it seems that the leadership is really concerned about something called moral hazard, that if you bail out participants in the economy for their bad behavior, you'll just encourage that behavior. And as I mentioned, the real culprit here is real estate. And it had, and also, understandably, it was hit by the pandemic, COVID-19 pandemic, which caught them with a lot of sort of poor performing assets that they shouldn't have been in. So what we're seeing is a regulatory strengthening, which will really, I think, be useful in the long term, because the financial controls that these firms themselves had in the real estate sector, and that their lenders didn't provide them guidance for, and that those lenders also didn't have a strict coverage from their own government regulators. So that whole process is being strengthened. And frankly, as the financial sector gets more complex, the regulatory system also has to catch up. And I think this is the major impact of that, given how much the real estate sector suffered in the pandemic.
Right. Look, I mean, stabilization and growth, obviously it's good for China, but for the rest of the world, not that they don't care, but I guess why should they care, or how does it impact, say, policymakers, maybe what they think in the U.S. or in Europe, if China is a little stronger or a little weaker?
Well, it does mean jobs. The U.S. exports a lot to China and wants to export more, particularly for foodstuffs, feedstuffs, and so forth. Other countries sending lots of inputs into China's manufacturing, selling equipment. China imports a lot of technology. So it's a huge boost to other countries' growth and employment. That's a huge factor, and I think that's why they should care. For the long term, the question is, will it return to upper level single-digit growth, which would mean that eventually would, by the end of this decade, say, in that case, overtake the United States in size. Is that a geopolitical issue? That's a whole other dimension of concern over China's long-term growth. The very sort of fashionable descriptions recently are that it will slow down to 2% or something and then not surpass the United States. But I think that's a kind of comforting news to some, perhaps, but I don't think these data point to that at all.
Albert Keidel, professor at GWU and author of China's Economic Challenge and Unconventional Success. Appreciate your thoughts on this. Thank you.
My pleasure. Thank you.